The global economy is heading for what the International Monetary Fund believes is the worst recession since at least the 1930s, when we had the Great Depression after the Wall Street crash of 1929. Governments are using unprecedented measures to support people through the coronavirus crisis by paying the wages of workers, offering government-backed loans to businesses. They're offering tax breaks and tax holidays to companies. They're, in some instances, paying money directly into people's bank accounts, as in the United States, where people were getting $1,200 credited directly to their accounts from the government.
There's a lot of people on unemployment. It's of biblical proportions.
Giving away money, it helps people to live through the coronavirus crisis when they need to make ends meet, when they have no more income coming in if they might have lost their job.
So to come through this and then you don't suddenly stop wages coming in my account, and I'm like, whoa, what am I going to do now?
It's not always practical to give away money. Governments don't always have the bank details of individuals. Some people may have more than one bank account, and you might not always know who has what income level just by giving them money directly. You don't want to be giving money to billionaires at the same time as somebody who is incredibly poor. Some free market economists are concerned that when governments dramatically expand the amount of spending that they do, that it crowds out private sector activity. However, one would argue that during this crisis, the private sector is coming under such great pressure that government spending is required in order to support people through the worst of the economic downturn.
We want to work! We want to work!
Another thing that is being done to stimulate economies through the coronavirus crisis is quantitative easing, which is when central banks, such as the Bank of England, purchase government bonds from financial investors, such as pension funds and insurance companies. This is done to lower the interest rate on government borrowing. It also lowers the interest rates on household borrowing, such as mortgages and personal loans, as well as on business loans. This can help companies and people borrow at cheaper rates. During a crisis, this is especially important that you need your money as cheaply as possible, and it also encourages you to spend once you're able to return to the shops.
Basically down to as close to zero as it can go. Bank of England cutting the bank rate to 0.1%.
So in March, when the UK economy was really suffering from the coronavirus crisis for the first time, the Bank of England decided to increase its quantitative easing programme by about 50%, £200 billion of additional money being pumped into the economy to take its total quantitative easing programme to £645 billion. The economy never properly recovered from the financial crisis in 2008. So when the financial crisis struck, quantitative easing was used to stimulate the UK economy.
For every family in this country, the stability of the banking system matters.
But because the recovery was never particularly strong, that quantitative easing programme was never fully wound down, and it instead had to be ratcheted back up higher again in order to support the economy during the coronavirus pandemic. Pretty much all advanced economies are undertaking some form of quantitative easing to varying degrees. The Bank of England here in the UK, the US Federal Reserve, the European Central Bank and the Bank of Japan being amongst the main central banks that are using this policy. With quantitative easing, there is a risk of inflation taking off, whereby prices rise dramatically. Inflation isn't a risk in the immediate term because the economy is slowing down so much that there isn't excess demand for the amount of goods and services available to purchase. Another risk from quantitative easing is that it pushes up asset prices, such as the cost of a house and other financial assets, such as stocks and shares in the financial markets. This can exacerbate inequality. While governments say they are doing all that they can during the coronavirus crisis, there's also shone a spotlight on the way that we run our countries and economies, and whether we entered this crisis in a weaker position because of the decisions taken over the past decade, the austerity measures in the UK and elsewhere around the world that have weakened the welfare safety nets that are supporting people through the health pandemic.